Hey everyone, my name is Tim. Welcome back to the channel. If you're interested in diving into the world of options trading, particularly selling options, you're in the right place. In today's video, we're going to break down exactly how to sell options, what implied volatility is, how to understand bid and ask prices, and we'll touch on the Greeks, key factors that affect your options trades. Let's jump right into it. First things first, let's quickly cover what it means to sell options. Selling options, also known as writing an option or writing a contract, involves you agreeing to take on the obligation to buy or sell 100 shares of an underlying stock at a specific price if it expires in the money on expiration date when the stock market closes. There are certain circumstances that the buyer of the contract can exercise early, but that's rare. I've only had that happen once or twice. When you sell a call option, you're agreeing to sell 100 shares of stock at the strike price if it expires in the money on expiration date. Conversely, when you sell a put option, you're agreeing to buy 100 shares at the strike price if it expires in the money on expiration date. As the seller, you receive a premium for taking on this obligation, but you're also exposed to potential losses if the market moves against you. So selling options is often considered a more advanced strategy. Now let's talk about implied volatility. Here on Robinhood, that's right here. It just says implied volatility, and this is a big one to understand when you're selling options because it directly affects how expensive the options are. Implied volatility, or IV, is essentially the market's expectation of how much the price of the stock will move in the future. Higher implied volatility means that the market expects larger price swings, and as a result, options premiums are higher. Lower implied volatility suggests the smaller price movements, leading to cheaper options. For option sellers, selling options during periods of high implied volatility can be beneficial, as the premiums you collect are higher. However, this does come with a risk. If the volatility spikes even more after you sell the option, the price of the option could increase and you might face potential losses. As an example, if I were to sell this Verizon put at 41 cents per share and the implied volatility went up, that means that the option price would go up, and if it goes up too much, I would take a loss if I tried to buy this option back on the expiration date or anytime between then. So that is something to keep in mind. As a general rule of thumb, many traders do prefer to sell options when implied volatility is higher, since the premiums they receive is higher. But it's crucial to manage your risk and understand the implications of volatility on the strategy. Now, the next most important part is the bid and ask prices that you see here on Robinhood, which are again on any brokerage. They just might look different than Robinhood's, but I'm just showing it because it's easy to see on Robinhood. These are essential to understanding when and at what price you will actually execute your options trades. The bid price is the highest price a buyer is willing to pay for an option, and the ask price is the lowest price a seller is willing to accept for that same option. The spread between the bid and ask prices represents the difference between supply and demand. A narrower spread means that there's more liquidity, and liquidity just means that there's more volume, more people trading that option in the market. And a wider spread could indicate less activity or interest in that particular option. When you sell options, you're essentially asking for the bid price because you're the one providing the option for sale. Ideally, you want to sell your options when the spread is tighter, and I typically don't sell exactly for the bid. I try to sell in the middle of the bid and ask price, but I'm willing to possibly not get my option order filled in that situation. A good rule of thumb is to look for options with a tight spread, as this typically means there's plenty of trading volume and that you won't lose too much money on slippage when entering your position. Alright, now let's talk about the Greeks. These are the factors that determine how much an option's price will move in response to changes in the various market conditions. The main Greeks are delta, gamma, theta, vega, and rho. You see them right here at the bottom of the options chain when I was looking at this option on Robinhood. So delta measures how much the price of the option will change for a $1 move in the price of the underlying stock. That means $1 up, $1 down. A high delta means that the option price will be more sensitive to change in the stock price. As an example, if I were to sell this option, that means that if the stock price went up or down $1, that the premium would go up or down by 33 cents. Keep that in mind, that the delta is also a good indicator for many option traders about the probability of their profit. So for instance, delta is basically taking this number subtracted from 100. So in this particular case, there would be a 67% chance that this option would stay out of the money and I wouldn't have to buy the shares and I'd get to keep the premium. That's not what it's officially used for, but that is what a lot of traders use it for. Gamma is the rate of change of delta. It shows how much delta would change if the stock moves. It's crucial to understanding how the delta will behave as the stock moves. For instance, in like the prior example, if the stock price goes up or down $1, like the delta will affect the premium, but then the gamma will affect the delta. So the premium will go up or down to either 74 cents or to 8 cents, and the gamma will change the delta to either 51 or down to 15. So that's how gamma would affect the delta if the stock price moves up or down $1. Theta represents time decay. This is especially important for options traders. As time passes, the value of an option tends to decay, and theta shows you how much value is lost per day. The closer the option gets to expiration, the faster it decays. For me personally, I tend to sell weekly options, so theta isn't as big of a deal for me, but if you sell longer time frames, 30 to 45 days, theta is a good indicator of how much of the value of the option will decrease each day. In this particular case, theta is saying that if I were to sell this option, every day, the value of the option would go down by 9 cents. Vega measures the sensitivity of an option's price to changes in the implied volatility. If the implied volatility increases, Vega tells you how much the price of the option will increase. And Rho is the measures the sensitivity of the option's price to changes in interest rates. It's far less important for short-term trades, but can be more relevant in changing macroeconomic environment, i.e. long-term trades. As a seller, you're generally hoping that theta works in your favor, because as time passes, the options you've sold lose value. Ideally, you want the underlying asset, i.e. the stock, to move less and for implied volatility to decrease, so you can buy back the option at a lower price and lock in your profit. To sum it up, when you're selling options, you're looking to collect premiums while managing risk. Here's what to keep in mind. Implied volatility can affect how much premium you collect. The higher the volatility, the higher the premium, the higher the risk. Understand the bid and ask prices to ensure that you're getting a fair deal when you're entering and exiting your trades. Again, I try to go middle of the road of the bid and ask prices to try to get a fair price. If you're trying to sell your option quickly and get it filled almost instantly, then sell it at the bid price. Pay attention to the Greeks, especially theta, because that'll help you understand how your options will behave over time and as market conditions change. Selling options can be profitable, but it's essential to understand the risk involved and to have a solid risk management plan in place. My risk management plan personally, and I'm not a financial advisor, but I suggest if you want to sell options to usually choose established companies that pay dividends. Just that way, if the market moves against you, if the stock price drops suddenly due to news or new laws or anything, you can wait it out patiently and you'll still collect dividends every 3 months or every month, depending on what stock you have, and it will help lower your break even and help bring in income. You do not want to sell a call after you purchase the price above the price that you've purchased them at. You don't want to lose money. You don't want to lose the premium that you've received. Thanks for watching. If you found this video helpful, don't forget to hit the like and subscribe button for more trading tips and drop any questions you have in the comments. See you next time.